Howdy y'all, I'm Raymond Dahlman and this is the weekly economic update for May 10th, 2021. I hope everyone had a fantastic weekend. It's a little cooler here in Colorado. We're expecting some more snow. Fantastic. So it shouldn't be too bad. But I did get a lot of chores done over the weekend. Cleaned the gutters, put up some screens on my wife's sunroom. What else did I do? Just some general stuff around the house. So anyways, like I said, I hope everyone had a great weekend and had a good Mother's Day. Hopefully everyone spoiled their wives and moms. All right, let's go ahead and dive into the weekly economic update. Last week, stocks were a little mixed based upon some of the jobs numbers, and I'll get into that in a little bit. The Dow Jones gained 2.67%. The standard S&P 500 was up 1.23%. But the NASDAQ lost 1.51, and the international or overseas markets, it gained 1.2%. So, all right. So, like I said, a bit of a mixed market, based on the recovery from the last year. But technologies and high valuation companies didn't really do quite as well. Part of that is due to the labor market. We were expecting close to, I think, 900 and something thousand jobs, and didn't quite go as planned. Here it is. The April employment number report rose 266,000, and came in well short of the 1 million new jobs that they were expecting. All right. As far as economic data this week, we have job openings and labor turnover tomorrow on Tuesday. Wednesday is the CPI, the Consumer Price Index. Thursday, jobless claims. And Friday, we'll have industrial production and consumer sentiment. As far as earnings, looks like earnings season is kind of coming to a close here. Today, we have Duke Energy, Simon Properties, Air Products and Chemicals, and Marriott. Tuesday will be Electronic Arts and Planeteer Technologies. Wednesday, Coupang, that's a company I've never heard of. And on Thursday, the Walt Disney Company. All right, let's go and look at the chart here. Shows the what was up and down over the last week. And let's look at these year-to-date numbers. The Dow Jones up 13.63, the NASDAQ 6.7, international 6.91, and the S&P 500 12.69. So we can see that the Dow Jones and the S&P 500 so far year to date have had the best performance, and international and what you would call your tech stocks in the NASDAQ have done well, but certainly not the same growth. Last week, the 10-year note lost 3 basis points. I know a lot of people have been paying attention to the 10-year and where it's been gaining or losing ground. It's been gaining ground as far as yield quite a bit, based upon the inflation that we're expecting coming up, and so we'll see where that goes. It's time will tell. All right, let's flip over to the monthly economic update. I'm disseminating that this week as well. For the month of April, again, we saw some robust numbers coming out of the markets. The Dow Jones was up 2.71%. The S&P picked up 5.24%, and the NASDAQ was up 5.4%. So, again, positive signs. We're seeing some good things. Job numbers up until last week were looking pretty good. Housing starts have jumped. So, like I said, all in all, not terrible, but we're gaining some ground back from all we lost over the last 12 months. So I'm looking for the positive signs in the rubble that is our economy right now. So let's see, what else was there. Some other news. GDP surged with a posting of a 6.4% annualized growth rate. Unemployment, employers added 900,000 jobs in March. We know that the April numbers weren't quite as good. Retail sales have been doing pretty well. The one thing I've been hearing a lot of problems with, and that's not really listed here, is just the supply chains are just completely out of whack. Been hearing a lot just from podcasts I listen to, and some of the news that I consume. Whether or not it's food or lumber, there's just things are completely bass backwards right now, and it's causing a lot of inflation in those sectors. So, all right, let's flip over to some of the articles that I'm putting out this week. The first one, Buffett and Powell talk inflation. On one side you have Warren Buffett, who's basically saying we're going to see a lot of inflation, and then in the other side of the ring you have Chairman Powell, who is sticking to his guns right now, doesn't want to raise interest rates. He believes that this is just a transitory effect on inflation. So we'll see. I have a second article here that I want to that I'm going to put out via email, or it'll be linked in this show notes for the podcast. It's called it's from First Trust, and the title is Biden and Powell versus Summers and Dudley. And essentially, in one corner you have President Biden and the Fed chief Jerome Powell, who again want to keep interest rates where they're at. And then the other side, you have Larry Summers and William Dudley, who are both, I guess, by their own admission, center-left economists. And they're saying, if let me come over here to this. Meanwhile, while William Dudley has issued warnings saying that he thinks the Fed is putting itself in a position where it will eventually have to start raising rates, it's going to have to do so aggressively. If the Fed is too slow to tighten, says Dudley, it will have to eventually catch up, and that catch up will not be pleasant for the financial markets. So, it's how is this going to turn out? Will keeping interest rates where they're at, have a detrimental effect to the economy and to our financial markets, or should we start raising rates today and to hope and stave off the inflation that we may see with all the dollar creation? So if you think back to the 70s, where a home in the early 70s, your average home might have cost you $9,000 or $10,000. By the end of the 70s, it was much, much higher. Same thing with cars, fuel. I mean, that was just a decade of a lot of inflation. And the remedy to that was Paul Volcker, who was the Fed chair at the time, to jack interest rates up into the teens. It was fairly unpleasant for those who were holding dollars and trying to keep their head above water from a net worth perspective. But it did solve the problem. And then going into the 80s, we had a lot of robust growth in our economy. So I kind of lean towards the side of, raising rates at this point. I mean, they've been kept at or near zero for such a long time. When they were starting to climb up prior to the COVID debacle, we were seeing that interest rates were going up, and the economy was doing just fine. And then this happened in the last year, and rates went back down to zero. So we'll see. Like I said, I lean on the side of raising rates sooner than later. But I'm just your humble financial advisor sitting here in the mountains. So take that with my opinion with a grain of salt. So. All right, the next white paper I'm putting out is college funding choices. You have a lot of choices out there for saving up for your kids' college. Probably one of the most common ones is a 529 college savings plan. I kind of relate this to put it into layman's terms, it's kind of like a Roth IRA, but for college expenses. And you can put funds in there up to a certain amount each year. And the growth is tax-free as long as you're using those proceeds for college expenses. So that's probably the most common one that a lot of folks use. The other is Coverdell ESAs, and you can put single filers with incomes less than $95,000 or joint with less than 109. You can put up to $2,000 into those accounts annually. So again, another solution for putting some money aside that should, let's see, contributions to Coverdale's are not tax deductible. Again, kind of like a Roth. So you don't get a deduction for putting money in, but you do get some benefit for using those funds later on. The other would be your UGMA and UTMAs, which are trusts that you can establish for kids' college. And actually, let me step back, to that $2,000 deposit per year. I mean, if you're starting very, very early, that might be a good solution. But with today's college costs, I mean, $2,000 doesn't really go very far, even at state schools. So, not to dissuade you from using these tools, but again, you might want to find some other vehicles that you can shove more money into. And then something that not included here, something I've used quite a bit with clients is to overly max fund your Roth IRAs, and you can always pull the principal out of those accounts with no penalties as long as you've had the account open for more than 5 years. So let's say someone is 25 years old and they're already funding their Roth IRA. I think right now it's like $5,000 or $6,000 you can put into that each year. You have two spouses, or husband and wife. So in simple terms, you could save say $10,000 a year into a Roth IRA, and as long as you're not taking any of the growth out, 20 years from now, that person's in their mid-40s. They've saved $10,000 a year for 20 years. You'd have about $200,000 in principal saved up. So you could use, up to the principal balance, to cover those college costs. So it's kind of like killing two birds with one stone. The advantage to this I like is that if little Johnny turns out to be a knucklehead and he's not going to go to college, you're just that much further ahead for your retirement and for just other uses. So, all right. So that's about all I had to say. I mean, I'm not a huge fan of sending every Tom, Dick, and Harry off to college. I think there's with where we're going, the academy system is kind of antiquated. I would personally recommend most people, push is probably the wrong word, but try and steer them towards technology or trades, something that, you're always going to need plumbers, you're always going to need electricians. If they're someone who's tech-minded, maybe coding or, engineering, something that has value in, and should, continue to hold that same value moving forward into our more high-tech future. So, all right. And the last white paper I had was baseball's $300 million players, and goes through all the different players who have these huge contracts, and what they can do from a tax perspective. It's a lot like folks who save for an entire lifetime, and when you build up a nice nest egg, you have to think about how do I want this taxed in the event that I pass away prematurely, or even if I live to a ripe old age of say 90 years old. How do I want my assets to be taxed, and to take advantage of some estate planning to minimize or eliminate having to pay taxes on those assets when you pass away. So interesting little read here. Alrighty, so let's dive in a little deeper to the U.S. non-farm payrolls. Last week's forecast was 978,000, and it came in at 266,000. So that is a pretty wide margin. I mean, last month's numbers were revised down from 916,000 down to 770,000 new jobs. But up until that point, it had looked a little bit better. So that's what's put a little concern into the markets, and we'll see what the numbers continue to look like on a weekly basis. The unemployment rate for April actually went up from 6% to 6.1. Pretty negligible. Not exactly a huge difference. But when you look at the forecast, we were forecasting 5.8%, and to have that number actually climb, again, something to keep your eye on. Let's flip over here to the U6 unemployment rate. It's currently at 10.4%, and this is basically all unemployed people. Includes people who are not looking for work or actively seeking work. So basically 1 in 10 people right now who could work are out of work right now. So, again, we are seeing this trend continue to go down, which is certainly positive. A year ago at this time, we were at 22.8%. So to cut that in half, is certainly a positive sign and things going in the right direction. All right, and then the last thing I wanted to talk about, and I hinted to this on Friday during my weekly wrap-up, is just the balances that the majority of our major central banks, the assets on their balance sheets do continue to climb. This blue line is the ECB, the European Central Bank. They're up to 9.1 trillion of assets on their balance sheets. The next highest is our Fed at 7.7, and these continue to climb up. There is a bit of a downtrend in the Bank of Japan and the Bank of China. They did tip over a little bit here at the looks like the first part of 2021. So that is some positive news. At least 2 central banks have slowed down their asset purchases. And again, I'm just looking at the numbers. That would be the assumption that I'm making here. And Europe and the United States continue to add assets to their balance sheets. So looking at total balance sheet assets right now for the 4 major central banks is now 29 trillion. So that's quite a bit. And looking over the last year, that number jumped from around 19 or 20 trillion. So it's gone up by about about 50%. So like I said, it is something to keep your eye on. How long this can go and how long and what would be a sustainable amount, I don't know. But like I said, it is something that I'm paying close attention to, and whether or not that's going to lead to a market meltdown or interest rates climbing could lead to something else. So really, I hate saying I don't know, but right now it's the best answer that I have. So. All right, well, that's everything I had for the weekly update. If anyone has any questions or concerns or comments, feel free to shoot me an email or give me a call. Please like, share, and subscribe to my newsletter. Share it with a friend or a family member. I certainly would appreciate it, and they might get something out of this. I know I do kind of ramble on for 15 minutes sometimes, but I'm just trying to push out the news that I think is relevant, and so that we have well-educated folks out there. At least the folks that I interact with, I want them to have access to as much of the information as possible. So, all right. Well, hope everyone has a fantastic week. And like I said, if you need anything, feel free to reach out. And I'll talk to everyone definitely by Friday. Bye-bye.